We could be witnessing the dawn of a new stock market supercycle. Lisa Mabartha, excuse me if I mispronounce that, Lisa. This is straight off the Business Insider website. Despite its huge rally from its March 2009 low, the stock market has effectively gone sideways for the last decade. Many have characterized the current market as a secular bear market. But in a new research report, Fidelity's portfolio manager, Jurrien Timmer, writes, from a technical perspective, the secular bear may be turning into a secular bull. Timmer examined how the S&P 500 has been performing since 1871 and discovered that on average, prolonged periods of below average returns, or secular bear markets, lasted about 14 and a half years on average. By that measure, the secular bear market that we are currently in is getting a bit long in the tooth, now in its 13th year, and going by historical patterns is likely to end. But it's not a sure thing that we're entering a bullish supercycle. Many investors, especially pension funds that have lowered their risk profiles dramatically, aren't really expecting the markets to go on a secular bull market. Nevertheless, Timmer thinks that the end of the bear market isn't too far off. The study of market history seems to suggest that maybe the worst is over, he writes. If so, it will be important for investors to take a close look at their portfolios to make sure they are not too defensively positioned for their investment mix in line with long-term goals. Timmer takes a close look at each of the previous secular bull and bear markets. Okay, here we go. I don't know if you can see this. Goes back all the way to 1871. Obviously, that's a secular bull market, secular bear market, secular bull. There we go. Here we are now. Okay. Let's go there. The first bear market lasted from 1902 to 1921, spanning a little more than 19 years. During that time, the nominal total return was 3.7 and the real return was minus 0.04. The PE fell from 1408 to 1414. Then we got a relatively short but sweet secular bull market of the Roaring Twenties. This period lasted only 8 years, yet the S&P 500 gained 27.5% in nominal returns and 27.8% in real returns. The PE ratio climbed from 14 to 20.2. Right in here. There's the Roaring Twenties. Wow, look at that. Look at that. Look at that spike down. Wow. Crazy. There's a bubble. The stock market bubble of the late 20s, along with other factors, of course, ushered the Great Depression of the 1930s. The secular bear market lasted until 1942. During that time, the nominal return for the S&P 500 was minus 5.2, and the real return was 4.6. The PE ratio fell from 20.2 to 7.7. The hallmark of that period was, of course, a lack of demand and resulting deflation. That is why real return was not lower than nominal return. So there's the 30s. Wow, this is a long one. The next secular bull market lasted from 1942 to 1968, more than 26 years. This was when America was the envy of the entire world. The war ravaged Europe and Japan needed American products if they were to rebuild. During this time, the nominal return was 15.1% and the real return was 11.7%. The market's PE expanded from 7.7 to 18.4. So, that's I think that's the highest PEs we've been known about here. The next secular bull market lasted. Oh, I'm sorry. Next one. There we go. I remember this. This is the first time I remember. This is the first thing I remember. Then came the stagflationary 1970s and another secular bear market. From the small cap bubble peak in 1968 to the double dip recession low that resulted from Paul Volcker's inflation fighting efforts, the S&P returned plus 4% in nominal terms, but minus 3% in real terms. The market's PE fell from 18.4 to 7.7. The period was all about low growth and high inflation, and you can see that from the numbers. There it is. Okay, next one. Bull. We then got into a deflationary and multiple expanding secular bull market of the 1980s and 90s. During the 18-year period, the S&P returned a whopping 19.1% in nominal terms and the still whopping 15.4% in real terms. The market's PE expanded from 7.7 to 28.6. Wow. 28.6. That's the highest we heard. It has been a spectacular year. Here we go. It has been a secular bear market since the bubble extreme formed in 2000. Stocks have been languishing, with the S&P 500 returning only 0.4% in nominal terms and minus 1% in real terms. The PE ratio has fell from 28.6 to 15.8. But the March 2009 low, it briefly fell to 9.6. This one. After 12 years in a secular bear market, it looks like the market is turning. Secular bear market, trailing PE. Okay. Secular bull market. All right, let's finish this up. We could be witnessing the dawn of a new stock market supercycle, but another secular downturn is within the realms of possibility. And there are plenty of reasons why this might happen in the U.S. fiscal situation for the problems in Europe, China, according to Timmer. But history tends to repeat itself, and from a technical perspective, there is reason for optimism that we are getting close to the end of a frustrating period of market history. All right, I want to go back to this here. Here we go. This is the candlestick of all the stock markets in the whole of most of the stock markets in the world. We got there's Australia, Austria, Belgium. There's Canada, France, Germany. There's Hong Kong, Italy, Japan. Japan looks a little sticky up there. I think that's Mexico. Some other countries are Netherlands. Yeah, I mean they're. Let's look at the Dow stocks. Looks the Dow for the last year. There we go. Well, some of them a little more, not quite as strong. Not quite as strong. Some of them are down, which is good. So yeah, that's what I forecasted earlier. I explained earlier that I thought 2013 was going to be a huge year for the stock market. And this guy is definitely looking a lot more out than I would. I was aware of the secular bull and the secular bear. The first person who made me aware of it was a guy named John Bollinger, who talked about the fact that these things run in cycles about 12 to 15, 14 years. I think the secular bear market might have started in like 1998, which puts us at 14 years, 14 and a half years. But we're just going to have to wait and see. Bye-bye.